Hello guys. Now let's look at this question. Please follow me through on this question carefully, because your understanding of this question will determine how well you understand the others. So follow me. It says that on 1st January 2011, an entity grants 100 share options to each of its 400 employees. Each grant is conditional upon the employees working for the entity until 31st December 2013. That's 3 years, 11, 12, 13. The fair value of each share option is 20. Now, we're told that during 2011, 20 employees leave. An entity estimates that 20% of the employees will leave during the 3-year period. During 2012, a further 25 employees leave. An entity now estimates that 25% of each employee will leave during the 3-year period. During 2013, a further 10 employees leave. Required. Calculate the remuneration expense that will be recognized in respect of the share-based payment transaction for each of the 3 years ended 31st December 2013. Okay. Now, in this question, the first thing you should notice is that the vesting condition is that the employee must work for the entity for a period of 3 years. That is to 31st December 2013. Hence, the remuneration expense will be recognized over the 3 years. Note this, please, because this is the key to everything. That at the end of each year, an entity must make the best available estimate of the number of equity instruments expected to vest. At the end of each period, they will do that. So let's see how to do that, because that's the key, really. So now, firstly, at the end of 2011, we need to calculate the value of the share option that is expected to vest at the end of the 3 years. And the question already solved that for us. It said during 2011, 20 employees leave. Okay, out of the 400, 20 left. Okay, they leave the organization. So on the basis of that, the entity now estimates, okay, this is what we need, the estimates they made. They estimate that 20% of the employees will leave during the 3 years period, okay? So is this 20% estimate of the employee that will leave during the 3 years? Okay, so that means at the end of the 3 years, we are estimating that only 80% of the employee will remain with us, and they are the one that will exercise this share option. Therefore, the estimate of the value of the share option at the end of 2011 will be 80% of the 400, okay, the number of employees that we expect to exercise their share option, multiplied by the number of share options per employee. Then we multiply by the fair value of the equity instrument. Okay? And that's 640. Now, this 640, the remuneration expense attributable to the current year, which is December 2011, will be 640 divided by 3. Okay, this 640 is for the 3 years. For this current year, 640 divided by 3. And that is 213,333. So with this amount, we will debit remuneration expense, we credit equity. Okay, because this is an equity settled share-based payment. That's the year 1. In year 2, the entity will make another estimate at the end of December 2012. The question also solved that for us. The question said a further 25 employees leave. Okay? And the entity now estimates. This is what we need. Estimate the estimate they made at the end of that period. Okay? They have to keep making estimates every year. Unless the question did not provide information about that. We'll still look at the question relating to that. So they estimate that 25% of its employees will leave during a 3 years period. You just have to understand it that way. So they are estimating that for these 3 years, at the end of 2012, we are estimating that, okay, 25% will leave. So only 75% will exercise their option. Therefore, at the end of 2012, the value of the share option will now be 75% of the 400 employees multiplied by the number of options per employee, which is 100, multiplied by the share price or the fair value, which is 20. It gives us 600,000. Okay. Therefore, the cumulative expense at the end of year 2 is 600,000 multiplied by 2 all upon 3. Okay. To get the cumulative expense for the 2 years, because this is the second year. So that gives us 400,000. Now, the remuneration expense relating to year 2 will be the increase in the remuneration expense. In year 1, we recognize 213,333. Okay? And the cumulative up to year 2, we have calculated it now as 400. Okay? So the increase in the remuneration expense now, because there's an increase, is what we're going to recognize in year 2, which is 400,000 minus 213,333. And that is 186,667. So we debit remuneration expense and we credit equity with that amount. I'm sure you're getting it. That's the process you have to follow. Okay? Now, at the end of 2013, the entity can now know actually how many of the employee will exercise, because that is the exercise dates, right? So they told us that a further 10 employees leave. Therefore, actually, because this is the year is vesting, we will have known what has happened. There's no need for estimate anymore. So therefore, the total employee that actually left in 2011, 20 left based on the correction. 2012, a further 25% left. In 2013, 10 also left. So a total of 55 employees have left so far. Therefore, the value of the option at the end of the third year, which is at the end of 2013, will be 400 minus all those that actually left. Okay? Which is 55. Okay? So we multiply by the number of share options, multiplied by the share price also, we get 690. Okay, that's the value. So cumulative expense is 690. So the remuneration expense for the year 3 will be the increase. Okay, year 3 is cumulatively 690, and up to year 2 it was 400. This is 400. So that relating to year 3 will be 290. So we debit remuneration expense with 290. We credit equity with 290,000. And that is how you determine it. Please, you need to understand this part before you move to the next video. The key to everything is that at the end of every year, the entity will estimate the number of equity instruments that we eventually vest. Okay? So on the basis of that, you attribute the one that relates to the current year. And that is it. Let's solve another question. See you.